Greetings again. This is Unit 4. We're going to talk about the income statement and using it for analytics. This is Segment 1 of this Unit 4 lecture. Let's get to the content. Again, I'll let you all go over the objectives. You may pause the video and review these should you like, but let's get to the content quickly here. So from an introductory perspective, a little bit different than the balance sheet that we talked about in Unit 3. An income statement summarizes revenue and expenses for a given accounting period, so over a period of time. Also might be known as a profit and loss statement or an operating statement. Kind of depends on which terminology you like to use. So it answers really the question, did the farm business make money? Has the agricultural business made money or not? Balance sheet doesn't really tell you that. That's where the income statement comes into play. So we're going to compare the beginning and year-end balance sheets, but that doesn't really calculate net farm income. So at the bottom here, I have a little diagram or time flow sheet of counting period. It could be January 1 to December 1. We can compare balance sheets at both the start of the year and at the end of the year, which would give you some comparison. But an income statement does that all over that period of time, has income, expenses, and profit for that period. So if we are going to then identify revenue and expenses, we have to look at all of those pieces that should be included in net farm income. Obviously, revenue is anything that the business earns during that accounting period. It has to be clear in what accounting period the revenue was in fact earned, because those can be cash or non-cash, and also accounts receivable. So cash received for crop delivery, value of grain in inventory or market livestock, and then earned revenue for which cash that you haven't gotten yet, accounts receivable again. Also, we're going to include on that revenue side of the ledger the gain or loss on the sale of capital assets. And there's a lot of information here on this slide. To boil it down here, basically what you're referring to is if we sold a big asset, like if we sold off a piece of land or sold off a piece of equipment that we did not replace, like a combine, whether it was sold for book value, that gets into a lot of different things here on this slide that I'll let you pause and review the slide. But bottom line is, you're probably not going to utilize this part of the income statement very often in terms of on the revenue side. I don't know very many farms that are in that growth operational mode that are going to sell off land very readily. So this would probably be not often used on your income statement. Easy enough then as we look at revenue, the same as expenses. All expenses incurred producing that revenue for the same given accounting period, whether they're cash, non-cash, and prepaid. Non-cash includes that depreciation that we talked about back in Unit 2. Also includes your accounts payable, accrued interest, and any other accrued expenses like property taxes. Now, prepaid expenses should be subtracted from this income statement. So again, back to our example I know we've talked about before. If you have already prepaid some operating expenses for the next cropping year, subtract those off of this income statement, because those will cloud the picture on whether you made money or not. But for our purposes, we're going to be considering before tax net farm income positions in this unit. So a basic structure of an income statement is total revenue less total expenses, and that gives you net farm income from operations. If we add in that gain or loss of capital assets, which I already mentioned, probably doesn't happen very often, that gives you then the net farm income. Occasionally we'll have cold breeding livestock shown as revenue and other things at the end of the statement, but those are usually considered part of normal production activity. So when we look at net farm income from operations and net farm income after the capital assets gain or loss, that'll help tell you whether it was unusually high or low sale on those assets. Help identify some things here. So here's a maybe a chart of accounts. Again, kind of a different way of looking at it. You could go through each one of those lines and on your own operation and list a number, cash crop sales for the year, livestock sales, cash inventory changes in crops or market livestock, and so on and so forth. And same thing with the expenses as you get down through there. But bottom line, as you get down to the bottom of this chart of accounts, you should hopefully come up with a net farm income number on that income statement format. So again, what we're looking at then more specifically, continue to drill down, is the value of farm production, kind of an intermediate step to helping with an accurate calculation. So if you look at that revenue, subtract out purchased feed and grain, subtract out purchased market livestock, that gives you value of farm production, less all the other expenses, gives you net farm income from operations. And then there's that capital asset sale again, which again probably won't use, so let's throw a 0 in there. That gives you that net farm income number. Did you make money or did you not for that accounting period or that year? So again, if we look at just a cash accounting system, we mentioned this back all the way in Unit 1, I believe, when we talked about the differences in accounting system approaches. And if we only use net farm income from a cash accounting system, it can really be misleading, especially if we have either prepaid expenses or moved sale of assets to different years. So it can really result in very poor decision making. And we'll discuss more of this in some of our assignments that we do. So that's a great reason to go into accrual accounting and why some of that recommendation is made, even though cash accounting systems are much, much easier. If you're using cash accounting, you might want to convert that net farm income to an accrual adjusted number at the end of the year, so you know whether you in fact made money, in each and every successive year, with all the revenues and all the expenses targeted and tracked to that specific production year. That's really important to know whether you're making money on a regular basis or not. Again, here is kind of a comparison grid, a crosswalk, so to speak. Cash basis on the left, accrual basis on the right. So you'd have cash receipts up at the top left and cash disbursements on the bottom left. Subtract out your depreciation expense and gives you cash net income pre-tax. If we adjust that, going towards the right of the screen or the right of the crosswalk here to accrual basis, we would have beginning and ending inventories, beginning accounts and ending accounts receivable, gives you gross revenue. And then the cash disbursements, again, beginning and ending accounts payable, so on and so forth, all the way through the bottom, making those adjustments for operating expense for the year. Same thing in the depreciation, it's not going to change. But at the end of the line then, we have accrual adjusted net income pre-tax. Again, a much more clearer and accurate picture of hopefully successful net farm income for the year. That's going to wrap up segment 1 of Unit 4 here. The next segment, we'll get into some more specific analytics on what an income statement can provide you. Thanks for tuning in.